Okay, so you want to own a property management company. You don't own the buildings. You don't carry the mortgage. You don't take on the risk of a market downturn wiping out your equity. You just collect a percentage of rent from other people's real estate, month after month, for doing the work landlords don't want to do themselves: screening tenants, fixing toilets, chasing late rent, filling vacancies. Somebody else owns the asset. You own the relationship and the recurring fee. That's the pitch. That's why property management gets pitched as one of the purest recurring revenue businesses in all of real estate, without ever having to buy real estate yourself. Here's the problem. Property management looks like a simple service fee business, and that framing hides the actual shape of this industry, which is really a portfolio of thousands of tiny, individually fragile client relationships, each one a landlord who can fire you with 30 days notice, sitting on top of an operations business that has to run flawlessly at 2 a.m. on a Sunday when a pipe bursts, all while carrying legal and financial exposure that most first-time owners dramatically underestimate. And once you understand that a property management company is really an emergency response operation wearing an accounting firm's fee structure, everything about how it actually makes money and how it quietly collapses under the weight of its own growth starts to make sense. Let's start with what this business actually costs to open, because the barrier to entry here is genuinely lower than almost any other business we've covered on this channel, and that low barrier is both the opportunity and the trap. You don't need a warehouse. You don't need heavy equipment. You need a license. Most states require a real estate broker's license or a specific property management license to legally manage rental properties for other owners, which usually means passing an exam and, in a meaningful number of states, holding an active real estate license through a supervising broker. You need property management software, which typically runs anywhere from $1 to $2 per unit per month for basic platforms up to considerably more for full-featured systems handling accounting, maintenance coordination, and owner and tenant portals. You need basic office setup, insurance, and enough working capital to survive the slow build of your first client base. All told, a lean startup property management company can genuinely get off the ground for $10,000 to $50,000, which is a fraction of what it costs to open almost any other business on this channel. That number is real, and it's also almost meaningless on its own, because it describes the cost of hanging out a shingle, not the cost of running an operation that can actually handle what property management requires once you have real clients depending on you. Here's the number that actually determines whether this business survives past its first 18 months, and it has nothing to do with the units you're managing. It's the cost of building an operations infrastructure that can respond to emergencies reliably, because property management is fundamentally a promise. The promise that if something goes wrong with a tenant's home at any hour, someone competent will handle it. Delivering on that promise requires either staff on call around the clock or a relationship with a third-party answering and dispatch service, a network of vetted contractors and vendors across every trade a rental property might need: plumbers, electricians, HVAC technicians, locksmiths, and enough financial reserve to front emergency repair costs before reimbursement from the owner comes through. New property managers routinely under-budget this operational backbone, treating it as something they'll figure out as they scale, and then discover during their first genuine crisis, a burst pipe flooding a unit at 3 a.m. on a holiday weekend, that figuring it out as you scale and having a tenant with nowhere to sleep and no plumber answering the phone are not compatible strategies. Now, how does a property management company actually get paid? The revenue model here has more layers than people expect, and understanding all of them, not just the headline management fee, is the difference between pricing this business sustainably and slowly starving it. The core fee is the monthly management fee, typically structured as a percentage of collected rent, commonly somewhere between 8 and 12% for single-family and small residential properties, with the percentage often dropping as the number of units under one owner's portfolio grows, since larger portfolios create real operational efficiency. On a property renting for $1,800 a month, a 10% management fee generates $180 a month in revenue for the management company. That number alone looks thin, and it is thin, which is exactly why the rest of the revenue model matters so much. Layered on top of the core management fee is a category the industry calls ancillary fees, and this is where a well-run property management company's actual profitability lies. A leasing fee, typically structured as 50 to 100% of 1 month's rent, gets charged every time a vacant unit is filled with a new tenant, covering marketing the listing, showing the property, and screening applicants. A lease renewal fee, usually a flat $100 to $300, applies when an existing tenant renews rather than moves out, which is both meaningfully less work than a full release and, not coincidentally, a strong financial incentive for the management company to actually invest effort in tenant retention rather than just chasing turnover fees. Maintenance coordination fees, often structured as a markup somewhere between 10 and 20% added onto the cost of any repair work coordinated on the owner's behalf, compensate the management company for sourcing contractors, scheduling access, and overseeing the work. Late fees collected from tenants are frequently split between the property owner and the management company, or in some contract structures kept entirely by the management company as an incentive to actually enforce on-time payment. And there's often a placement or setup fee charged when a new property owner first onboards with the company, covering the initial work of inspecting the property, setting up systems, and getting it market ready. Add all of this up across a real portfolio, and the ancillary fee revenue on a well-run property management company frequently equals or exceeds the base management fee revenue itself. This is precisely why sophisticated property management companies don't think of themselves as charging a management fee. They think of themselves as running a fee-stacking business built on top of a management relationship, and the companies that only ever collect the headline percentage, leaving the leasing fees, renewal fees, and maintenance markups unstructured or underpriced, are consistently the ones that struggle to turn a genuinely profitable margin even while managing a respectable number of doors. Which brings us to the metric this entire industry actually runs on, doors, meaning the total number of individual rental units under management, and specifically the cost to acquire each one, because property management is a business with genuinely brutal unit economics at small scale that improve dramatically, sometimes dramatically enough to change the entire viability of the company, as the portfolio grows. Here's the uncomfortable math a lot of first-time owners don't run before they start. A single property manager, realistically handling the day-to-day operational load, tenant communication, and coordination for a portfolio without things falling through the cracks, can typically manage somewhere between 100 and 200 doors effectively, depending on the property type, the geographic spread of the portfolio, and how much of the maintenance coordination and leasing work is handled by separate specialized staff versus that same generalist manager. Below roughly 50 to 75 doors, in most markets, a standalone property management company is genuinely struggling to cover its fixed costs, software, insurance, licensing, a baseline of staff time, purely from management fee revenue, and is often functionally subsidized by the owner working unpaid hours or by ancillary revenue carrying a disproportionate share of the load. This is exactly why the earliest phase of almost every property management company's life is the hardest phase, a genuine grind of acquiring clients one relationship at a time until the portfolio crosses the threshold where the fixed operational costs finally start spreading across enough doors to generate real margin. Client acquisition in this business is also structurally different from a lot of the other businesses on this channel, because you're not really selling to tenants. You're selling to property owners and real estate investors, a category of customer that tends to be financially sophisticated, price-sensitive, and, crucially, deeply relationship-driven, because they're being asked to hand over control of what's often a meaningful chunk of their net worth to someone else's judgment and competence. This means the sales cycle for landing a new property owner client often runs through referrals from real estate agents, mortgage brokers, and existing satisfied clients far more than through traditional advertising, and building that referral network takes years, not months. It also means the client relationship itself carries a genuine and ever-present cancellation risk that most other recurring revenue businesses on this channel don't face in quite the same way. A property owner client can typically terminate a management agreement with 30 to 60 days notice, sometimes even less depending on the contract terms, which means every single door in your portfolio is, in a very real sense, still being sold every single month, even after the ink on the original contract has long dried. This is the structural fact that separates a genuinely well-run property management company from one that's quietly bleeding clients while looking stable on paper. Client retention here isn't primarily about the monthly fee percentage, it's about response time, communication quality, and financial transparency, because the property owner is fundamentally trusting you with their asset and their cash flow, and any breakdown in that trust, a maintenance issue handled poorly, a late or confusing owner statement, a tenant placed without adequate screening who then causes damage, is exactly the kind of thing that triggers a phone call ending the relationship, 30 days notice, and the loss of every dollar of ancillary and management revenue that door was generating, with no severance and no warning beyond that single conversation. Now let's talk about the liability exposure in this business, because it's genuinely more serious than most first-time owners appreciate walking in, and it's one of the reasons property management, despite its relatively low startup cost, is not actually a low-risk business to operate. Fair housing law violations represent one of the most financially dangerous exposures in this industry. Federal fair housing law, along with a growing number of state and local ordinances, prohibits discrimination in housing decisions based on protected characteristics, and property managers, who are handling tenant screening and selection on behalf of dozens or hundreds of individual owner clients simultaneously, are directly on the front line of compliance risk. A single documented fair housing violation, even an unintentional one arising from an inconsistently applied screening criterion or a poorly worded rental advertisement, can result in federal and state penalties, along with a private lawsuit from the affected applicant. And the reputational damage from a public fair housing complaint can meaningfully damage a property management company's ability to recruit new owner clients in that same market for years afterward. Security deposit handling is another area where property managers carry genuine legal exposure, because most states impose strict, specific rules around how security deposits must be held, sometimes requiring segregated trust accounts entirely separate from the company's operating funds, strict timelines for returning deposits after a tenant moves out, often 14 to 30 days depending on the state, and detailed itemized documentation of any deductions. Mishandle a security deposit, commingle trust funds with operating funds, miss a statutory deadline, fail to properly document a deduction, and many states impose statutory penalties that can run to 2 or 3 times the deposit amount, payable directly to the tenant, on top of the original deposit itself. Multiply that exposure across a portfolio of hundreds of units, each with its own deposit and its own move-out timeline, and trust accounting isn't a nice-to-have back-office function in this business. It's one of the core legal safeguards the entire company's survival depends on getting right, every single time, without exception. Habitability and maintenance liability is the third major exposure category. When a property management company takes on responsibility for maintaining a rental unit and fails to address a legitimate habitability issue, a broken heating system in winter, a mold problem, a safety hazard, in a timely manner, both the property owner and, in many jurisdictions, the management company itself can be held liable for resulting tenant injury or property damage, and in the more severe documented cases, this liability has extended to significant personal injury judgments where a management company's slow response to a known hazard was found to have directly contributed to a tenant's harm. This is exactly why errors and omissions insurance, along with general liability coverage specifically tailored for property management operations, isn't optional in any serious version of this business, and why that insurance cost, commonly running several $1,000s a year at minimum and scaling upward with portfolio size and coverage limits, has to be built into the fee structure from day one rather than treated as an afterthought once the portfolio has grown large enough that the exposure becomes obviously uncomfortable. Let's talk about staffing, because this is where a property management company's actual operational cost structure lies, and it scales in a way that surprises owners who modeled their growth purely against door count and management fee percentage. As a portfolio grows past that single manager ceiling of roughly 100 to 200 doors, the company typically needs to add specialized roles rather than simply hiring more generalist property managers. A dedicated maintenance coordinator, handling the logistics of scheduling contractors, tracking work orders, and managing the vendor relationships, becomes necessary well before the portfolio is large enough to justify a full department. A leasing specialist, focused specifically on marketing vacant units, conducting showings, and processing applications, frees up property managers to focus on retention and owner relationships rather than the transactional churn of constant turnover. Bookkeeping and trust accounting, given the legal sensitivity we just covered, often warrants dedicated staff or a specialized property management accounting service well before a generalist bookkeeper would suffice for a business of comparable revenue in almost any other industry. Fully loaded, including salary, benefits, and payroll taxes, each of these specialized roles commonly costs a growing property management company somewhere between $50,000 and $90,000 a year depending on the market and the role's seniority, and the sequencing of exactly when to add each of these positions. Too early in the fixed cost outpaces the revenue base supporting it. Too late in service quality degrades in exactly the way that triggers the client cancellations we discussed earlier, is one of the genuinely difficult judgment calls that separates property management companies that scale profitably from ones that scale their way into a cash crisis. Technology and software costs deserve their own mention here, because this industry has been reshaped significantly over the past decade by the maturation of property management software platforms that handle owner and tenant portals, online rent collection, maintenance request tracking, and trust accounting in an integrated system. While the per-unit software cost sounds trivial in isolation, typically a few dollars per unit per month, that cost scales linearly and directly with door count in a way that most of this business's other costs don't, and switching software platforms once a company has built years of historical data, tenant records, and owner relationships inside one system is a genuinely painful, expensive, error-prone undertaking that locks companies into their initial platform choice far more permanently than the modest monthly fee would suggest. So let's put together what a real property management company's financial picture actually looks like over a full year, because this is where the optimistic and realistic versions of this business genuinely diverge, and the gap between them is driven almost entirely by variables that are hard to see from the outside. In the optimistic scenario, you've built a portfolio of 300 to 500 doors through years of consistent referral-based client acquisition. Your average management fee runs around 9% of collected rent on properties, averaging $1,800 to $2,200 a month, and your ancillary fee revenue from leasing, renewals, and maintenance coordination markup roughly matches your base management fee revenue, which is the sign of a genuinely well-structured fee model rather than one relying purely on the thin core percentage. Under those conditions, total annual revenue for a property management company at that scale commonly lands somewhere between $900,000 and $2 million, and a well-run operation with appropriately staffed maintenance coordination, leasing, and accounting functions can achieve net profit margins in the range of 15 to 25% once past the early growth phase, translating to owner earnings somewhere between $150,000 and $400,000 or more a year, alongside a business that, because of its recurring, contractual revenue base, typically commands a real acquisition premium if the owner eventually chooses to sell, since institutional and private equity buyers have become increasingly active acquirers in this exact space over the past several years, consolidating smaller regional property management companies into larger platforms. In the realistic scenario, a few unglamorous things go wrong that aren't exotic risks at all. They're the ordinary operating risks of this exact business. A wave of owner clients, representing a meaningful chunk of the portfolio, all list their properties for sale within the same 18-month window during a strong seller's market, and each sale typically means the loss of that management contract, since a new buyer frequently brings their own management arrangement or self-manages. A key maintenance coordinator leaves, and the resulting slowdown in repair response times triggers a wave of owner complaints and, within a few months, a handful of client cancellations that compound the staffing gap that caused the problem in the first place. A fair housing complaint, even one ultimately resolved without a major penalty, consumes months of the owner's time and a meaningful legal bill, while quietly damaging the referral pipeline in that local market as word spreads among real estate agents about the complaint. Under those conditions, that same $1 to $2 million revenue business can slide from a comfortable double-digit margin into a thin single-digit margin, or into a genuine operational crisis where the remaining staff, stretched thin, start making exactly the kind of service quality mistakes that trigger further cancellations. A downward spiral that's much easier to fall into than to climb back out of once client trust has been shaken across a meaningful share of the portfolio. None of this shows up as one dramatic failure. It's a slightly higher client churn rate, a slightly slower maintenance response time, a slightly more expensive round of hiring to replace a departed coordinator, compounding quietly month after month until the door count on the spreadsheet is heading in a direction the owner didn't plan for and didn't see coming until it had already been happening for 2 quarters. So does owning a property management company actually work as a business? The honest answer is that it works remarkably well for owners who understand from day one that they're not really selling a management fee percentage, they're selling reliability, responsiveness, and trust to a client base that can and will leave with 30 days notice the moment that trust breaks down, and who build their fee structure, staffing, and operational infrastructure around protecting that trust rather than around the thin headline percentage that gets quoted in the initial sales pitch. The recurring revenue really is genuinely powerful once a portfolio reaches sufficient scale, and the ancillary fee structure, properly built, can turn a mediocre-looking management percentage into a genuinely strong business. But almost none of the real work in this business is the work implied by the pitch of collect a percentage of other people's rent. The real work is answering the phone at 2 a.m., getting the trust accounting exactly right every single time without exception, and building the kind of operational reliability that makes a property owner, who could fire you next month with a single conversation, choose not to, year after year, door after door.